Hi traders, Nathan Bray here from ACY Securities. Well, part 5, today in our training modules, let's talk about what we're going to do once we're in a trade. How do we manage the trade? How do we decide where we're going to call the trade a loser? How do we potentially get risk out? And then how do we call the trade a winner and get out of that trade in profit? This is what we're going to look at right now. We have been through the whole process of looking at why we're entering a trade, identifying a key level, waiting for a trigger to occur. But now we're in the trade, let's take a look at how we might plan in advance to choose where we're going to exit the trade or how we're going to manage our risk once we are in the trade. So let's get in and take a look to begin with at Gold USD, okay, on a weekly chart.
We're looking at gold against the US dollar, folks, on a weekly chart. And as you can see, the area I've marked in is this weekly level of support. Those dots indicate that. And again, if you want this indicator with your trading, feel free to ask your account manager. We'll get it out to you on MetaTrader 4. So I'm using this level of support and we're going in line with the longer term trend, which is up. So pretty straightforward. And I've marked it in as green. So I'm looking for a significant retracement, which we've had. So that's the rationale for the level. Now, if I move into the daily chart, okay, we can start to look at this level being tested. So here's our initial level. Comes back down, tests it again, price rallies quite strongly away from it, enough for us to look for a trade. And it comes down for a retest a few days ago and price has moved up from there. So significant retracement. Trend on the long term is definitely up, and a weekly and now daily level of support identifies the level. And then, of course, we can trigger in by zooming into the 15-minute chart. Let's do that. So you can see this level, and I'll make it a little bit smaller, but there it is there. So let's just move that back. You see that green line? This is our trigger. Price comes down, respects this zone I talked about, and we get a trend line break. We get our MACD cross, we get an upswing occur as well. So whichever trigger combo you're using, we certainly get a trigger into this trade. So the question becomes, what do I do once I'm in the trade? So I'm going to move it back for us here to a daily. And if we get a trigger in, which we did at this point for various reasons, and we've triggered into the trade pretty much on that black line, the question then becomes, how do I decide what I'm going to risk and potentially what my reward's going to be, and also how am I going to manage the trade? So let's just go through that process. So let's look at entering into the trade, and we could place a stop loss. So the first thing I'm going to look at, the area I've got marked in as green, is sort of the zone I would like to trade in. So I would therefore use the recent lowest point here, and you can see it, it's about 2,277.68, okay? That's the lowest point. So I might look at this level I'm entering and say, maybe I'll give it enough room to move around, but once it gets below this level, which is about sort of $15, $16 away, I'll put it a little bit below there, let's say $20 risk. Okay, so if I'm risking $20, I might have a view that as soon as we're up $20, which occurred on this day, let's just measure it, well over. So whatever I'm risking, I could then decide that once price moves in the direction, the same amount that I'm risking. So if I'm risking $20, once it goes up $20, I might say I'll take risk out of the trade. So I'll move my stop loss and put it just a few pips above where I've entered. In effect, now I've got risk out of the trade. Whatever happens, happens. So that is just a really simple way of placing a stop loss for a reason, and then being able to get risk out of your trade for a reason as well. And that way you can just follow that strategy. Now, the question becomes, where do we take profit? So if I'm risking $20 and I'm entering at, say, 2293, let's just call it 23, then if I have a risk reward of, say, 2 to 1, then I need to be able to look at least $40. If I'm risking 20, I need to make sure there's at least $40 that I'm going to make, okay, as a simple approach. Right now, price has easily hit that target at a simple 2 to 1. Let me show you again. So I'm risking, say, 20 approximately to make 40. Why is that important? Well, the idea is if you're risking 20 to make $20, then you need to be right a lot. In fact, an awful lot. Whereas if I'm identifying a level, looking for a trigger, and I've got a reason for a stop loss, if I'm risking 20 and then I make 40, then in effect, I don't need to be right anywhere near as much. In fact, I could just be right 50% of the time. Think about it that way. If I'm risking $20, just to use a number, okay, then, and I'm wrong, then 5 trades, I'm going to lose $100, okay, because 5 trades with a risk of $20. But if I was right half the time, and when I was right, I was making, say, $40, suddenly I'm able to profit, okay, which is really why we're doing these strategies, and profit significantly. Now, if it turns out I've got risk out of a few trades as well and there is no loss, then I'm in a position to find an edge with risk reward that allows me to be profitable over time. And that's why we're trying to identify, before we enter a trade, what is my target and what is my risk reward. So if I now put this back on a 15-minute chart from the entry, you'll start to see, I think, it a little bit clearer. So this is on gold, and you can see sometimes you don't need to go to the previous low, but if you've entered here, and in this case, you're only risking, say, $8 or $9 because you went below the most recent low point, then you need to make about 16 for that risk reward scenario to be 2 to 1. And you can see you'd already be out in a few hours and make more than that 2 to 1 risk. So that, folks, is what I'm getting at. And if price was to run up here, you'd be saying, I'm already up $8 at this point. So I could move my stop to break even and sit at literally a couple of pips in front of where I entered. And you're effectively able to go to sleep, right? And knowing that the worst case scenario is you make nothing or just a couple of pips of value. So that allows you then to free up a scenario where in future you could use more margin. Why? Because the margin being used isn't going to go anywhere because you've got risk out of that trade. And that allows you to look for other opportunities. So just to wrap that up, folks, we're looking at saying I'm setting a stop loss for a particular reason, okay? And I'm looking for at least a 2 to 1 risk reward. And I'm also looking at getting risk out of my trade so it becomes a no risk trade. Now, the whole purpose is, even if you're wrong and you do this 10 times in a row, could this strategy of managing your trade get you in a position where you could potentially be profitable over a whole number of times of trades, knowing you don't have a crystal ball and know the outcome? So following up, folks, if you've got any questions about this simple approach to managing your trade and exiting your trade, knowing when to call the trade a loser and knowing when to call the trade a winner, feel free to ask any questions in Duncan Cooper's webinar. But that's all from me. Have a great day.